Hi, this is Patrick Henry from QuestFusion with the Real Deal What Matters. I'm here today with my dear friend, Robert Kibble, who is a managing partner at Mission Ventures. And for those of you that are entrepreneurs and run startups, when you're dear friends with a VC that was an investor in your company, that means you made them money. So typically they're not your friends afterwards if you don't. Robert co-founded Mission Ventures and has over 30 years of venture capital experience. He's a real expert in the space. Previously to Mission, he served for 13 years as a founding general partner of Paragon Venture Partners. And prior to that, Robert was a vice president at Citicorp Venture Capital and also served as a vice president of Citicorp's Merchant Banking Group. Robert's early career also included investment banking on Wall Street. Robert serves as a director of about a dozen different companies.
Have been, yeah.
Yeah, and he's the also was a director of the National Venture Capital Association. He has an MBA from Darden School at the University of Virginia and a bachelor's degree with honors in natural science from Oxford. Robert is a British guy, and you'll notice by his accent. But I wanted to welcome Robert. Thanks for doing this today. Why don't you tell our listeners a little bit about yourself personally and how you got into venture capital?
Well, I was born indeed in England, near London, and went to Oxford University. After that, I worked for Shell, the big oil company on the chemical side, and decided that in order to get a real business education, I should go to the United States. So I went and applied to the University of Virginia, went there. That was a great experience. I was very fortunate. Then worked on Wall Street, as you said, for a couple of years only. Had a very difficult time on Wall Street.
Was this in research or investment banking?
I was in investment banking. I was in corporate finance. I'm an associate doing all the grunt work.
Okay.
And you know what that is, working for partners who had a much easier time.
Sure.
So the lights were on late at night. And then after that, during the really very depressing time, our firm was going to be bought by another firm that didn't have a particularly good reputation. I decided to look around. I wasn't fired. In fact, they wanted to keep me. They offered to send me to Los Angeles, ironically, and here I am in San Diego. But I joined Citicorp, worked in Malaysia in a startup merchant bank, and then after that in Brazil in a startup merchant bank.
Wow.
Affiliated with Citicorp, but
okay.
Separate building, different name of the company was different, majority owned by Brazilian, majority owned by Brazilian, by Malaysians, and then came to the United States, joined Citicorp Venture Capital, and I've been here in California ever since 1980.
Okay, great. So what do you think are the best qualities of being a good venture capitalist?
Well, I think, you know, for one thing, I don't think you have to come from any particular background to be a successful VC. Witness, you know, Mike Moritz, who actually happens to be another Brit, a Welshman, mind you, who, you know, was a journalist and I think a history major. You don't normally associate that with high-tech venture capitalists.
Okay.
Most venture capitalists, I would say, tend to have an engineering degree and somebody who has had a background in a kind of company that you might invest in. Mm-hmm. But you don't have to have that as a requirement. So the qualities really are more, I think, to do with you certainly have to be analytical. Sure. You've got to do really rigorous work in terms of trying to understand what's going to make a company successful. What are going to be the impediments to success? Mm-hmm. Every aspect of it. You're looking at the technology, the operational side, the financial equation, as well as, you know, ultimately cost management. But I think above all, the biggest single factor, in my opinion, not everybody might agree with this, but for early stage venture, at any rate, is trying to find an opportunity where the market is just about to explode.
Sure.
And the growth is going to be very rapid, but is in a market that most likely most people, it's not written about in the Wall Street Journal, New York Times, or some of these research magazines. It's something that people don't really kind of realize is coming until it's there.
Yeah.
And that's, you know, that's more art than science. then I think you have to be able to show leadership qualities, and you have to be able to persuade entrepreneurs to have an influence, which is most likely if you're an early stage venture capitalist, you're going to go on the board of the company. You need to work with management on corporate strategy and the issues facing the company, financial strategy, and you've got to persuade your co-investors if you're going to be the lead investor at any rate. And I think you want to have the capability of being a so-called lead investor, where the syndicate really looks to you as the principal major shareholder in the company.
Okay. And does Mission and the other, venture capital companies you've been involved with, are they typically the lead, or do you typically take board seats? Or?
We often go as a co-lead with another firm.
Okay.
And you develop a relationship with that firm, and of course with management you work together. And occasionally we're more a passive investor where we're not the lead, and we may not be on the board, although that's been very rare in our case. Usually we are represented on the board of the company.
Okay. So how do you see, the landscape and the market of venture capital evolving? I mean, it seemed like, it was just a burst of different firms that emerged, in the kind of pre-telecom bubble of, 1999, 2000, but they're 10-year funds, so it takes a while to kind of weed things out. It seems like we now have these mega funds, these billion-dollar funds, and not so many missions anymore that, maybe have $100, $200 million fund. What do you see going on in the overall industry?
Well, it's easier to look back and talk historically about what perhaps has happened and try to analyze it. What's going to happen in the future, I don't know.
Yeah.
And I think we are at a very interesting transition point in the venture capital industry in terms of its evolution. So, yes, in my view, you're absolutely right. During the internet era, if we don't want to, we could look further back than that, but
sure.
Well, let's start from there. A lot of money was created, sometimes companies that weren't, frankly, particularly worthwhile.
Sure.
A lot of companies even went public that should never have gone public. And a great deal of money was raised, I think over $100 billion in 2000 in the venture capital industry.
In that single year?
In that single year.
Wow, that's crazy.
Now it's more like 20 to 30 billion. But the big change in the market, and it's changed for entrepreneurs as well as VCs, is the fact the IPO market has really, unfortunately, diminished significantly for much smaller companies. I mean, if you're a very large company, you've got 100 million in revenue, you're profitable, you're growing well, it's not a problem. You still certainly are an IPO candidate. But if you're, and the other exception to that is obviously if you're a Twitter type company, you've got absolutely spectacular growth, asymptotic growth. And people believe that the business model will ultimately lead to revenue generation in some form or other. Snapchat or what have you, they're all,
sure.
I mean, YouTube didn't have any revenues for many years. Eventually, of course, it's evolved to an advertising model that is providing very good revenue now to Google. But if you didn't have that, it's very difficult to go public. And the biggest single contributor, in my opinion, to that was the decimalization of trading, which is a good thing. I mean, it's more efficient trading in the stock market shares. You only, just a few cents a share every time the broker gets, every time shares are traded. And that makes it more efficient, less of a cost to the entity selling the shares. But the problem is today, that means if you're only raising 30 million, say, in an IPO, you can't really expect the investment banking firm and all the syndicate to make any money out of it.
So you think it's more based on the spreads associated with the trading as opposed to things like Sarbanes-Oxley, which creates more overhead, and more of a cost for a company to be public and all the things associated with it?
Well, certainly Sarbanes-Oxley was a big issue when it first came out, but the costs were even higher than they are today.
Yeah.
And they're still pretty high. Yeah, definitely regulation and Sarbanes-Oxley is an impediment, but particularly in this wonderful country of America, where everybody's terribly suspicious of government, and you never want to give credit to government of any kind. in this country, I think people really like to blame Sarbanes-Oxley, but actually, ironically, it was government regulation in a sense by stripping away the commissions paid on for brokerage firms that made the market more efficient.
Yeah.
That actually created this problem, at least for small early stage companies.
Okay. So most of the exits are really mergers and acquisitions as opposed to IPO.
Yes, it used to be you'd have this wonderful two-track system. A company would say, "Well, we're going to do an IPO. We're working in RS1, and we're also talking to a number of strategics." And the strategics eventually figure this out that, "Oh, yeah, you're really doing an IPO. You're not doing an IPO." And of course, they could get better value if you needed to sell.
Sure.
So it's been an issue and a problem. So lack of liquidity, I think, is the biggest single issue facing the early stage venture industry. And to your point, the mega funds and large funds, the place to be in the last 15 years would have been to have a lot of money. You can't do it with a little money. You would have to have had, let's say, in the mid-2000 period, $100 million fund at the minimum.
Yeah.
And if you had that and you did later stage stuff, you could basically cherry pick the whole venture industry.
Yeah.
And look at all the portfolio companies of all the early stage venture firms, and the ones that seem to be, doing very well, you could kind of pick those. Or, when Mark Zuckerberg turns up in your office and says that wants to move from Boston to San Diego and look at the traction I've got in my company. He doesn't have any venture capital, probably didn't have very little, even angel money, very little anyway.
Yeah.
You might go for it, and you pay a big price.
Yeah.
What seems to be a big price, in retrospect, was a very small price relative to, of course, that current market. So there are some real huge winners.
Yeah.
But the problem for many VCs is that most of them are in Northern California.
Yeah. And has that always been the case that, so I've seen some statistics around this that, let's say you invest in a number of companies and a third of them go under and a third maybe make a little bit of money. So it's really that top third that you count on to drive your returns? Or how do you think about it, both from a seed stage standpoint as well as a late stage standpoint? What kind of return are you looking for? We always hear about, you need a 10x return for you to get any interest from a venture capitalist, or maybe a late stage, maybe they're okay with a 3 to 5x return. So how do you think about that, and then what do you think the overall industry thinks about that?
Well, I'm glad you talked about 2x, 3x, 10x returns.
Yeah.
We don't do discounted cash flows on early stage companies. It's too complex for us. We don't understand it. No, actually we do understand it, but it doesn't make any sense. So, but that formula, a third, I think was a pretty good formula in the old days. Mm-hmm. I think today we don't, of course, know for sure until we look back in time.
Sure.
With a 10-year ability to look back 10 years.
Yeah.
But I suspect that the percentage of losers is that much higher.
Yeah.
I think the percentage of winners, and it depends on what you define as a winner, of course, but is fewer, and the fewer really big hits. Yeah. So out of that 1/3 of winners, it used to be that 1 or 2 companies would really make all the difference in that fund.
Yeah.
And I think nowadays they're tougher to come across.
Yeah. So you really have to be in these mega funds to see the deals that have the potential to kind of make the fund type of thing, or is it more of just there's fewer companies out there that will have those kinds of spectacular returns?
I think it's a percentage thing. I think the much fewer will have a big return. And I think, again, it's related to access to the capital markets, in my opinion.
Yeah.
Now, there's one segment of the market, which is in the internet segment, mobile communications, the internet, where you can get this consumer-facing applications, where you can get this and nobody knows for sure. If a guy came along with or a gal came along with an idea to start a company, and it's just a very simple business plan or whatever, and said, I'm going to get 100 million users over 5 years.
Yeah.
You'd sort of scratch your head and say, well, show me, right?
Yeah.
and you want to see some real traction.
Yeah.
And it's very difficult to tell ahead of time, frankly, what is really going to take off with the consumer. I mean, if you look at Snapchat, I mean, maybe it sounded like a good idea, but it depends on how well it's going to be implemented. Is it easy to use? It obviously has had tremendous traction.
Yeah.
But could you have predicted that beforehand? I think very difficult to do so.
Yeah.
So I think what has happened is that there are very few of these companies that really take off like crazy.
Mm-hmm.
And the angel investing community in particular has got enamored by thinking that maybe we'll be lucky. It'll be like, winning the lottery, I guess.
Yeah.
And many of these incubators and have started up, but starting many companies. In some cases up in Northern California, as I understand, and to some extent down here, they're emulating them here in Southern California. A whole bunch of little companies are being started, and I think that the hit rate is going to be very low, but
this would be like 500 startups and Y
be,
Combinator and
yes,
okay.
And I mean, how many are going to be winners?
Yeah.
I mean, just literally a handful.
Yeah.
But the returns have been so spectacular.
Yeah.
That they really have covered the costs, probably of the other 492.
Yeah. But it had so there was the third, then there was also this Harvard Business Review study that 75% of venture-backed startups fail. So that kind of plays more to what you're saying. Hey, there's going to be fewer winners going forward, but so you have to get the real big winners in order to get a return on the fund. What have been kind of the more recent? Are there good statistics around the recent kind of returns, the IRRs on the recent funds, or is that data still not available yet?
No, I think it is available with Cambridge Associates puts out those numbers and tracks it out of all they're one of these advisors to the pension funds, insurance, endowment funds and the like, and out of all the funds that they cover, they, on a no-names basis, they keep statistics, they aggregate them and so forth.
Okay.
I haven't frankly looked at them recently, but I believe the returns are not too good.
Okay. Okay. So you were a director of the National Venture Capital Association. What was that like?
It was actually a good experience. It's a 4-year term. We have term limits. And
I like that.
And there were quite a few of us. It's not like a small group. It's like, I don't know, I can't remember now, 16 I think, or something like that, or 14 board members.
So kind of like the Federal Reserve Bank.
Something like that. Because there's an inner committee and there's the chairman of the National Venture Capital Association, who's elected by the rest of us.
Okay.
But I worked a little bit on capital formation, and we, under a gentleman called Dixon Dodd, we put together a whole paper that we submitted to various the SEC, various agencies, to try to encourage them to frankly cull or change Sarbanes-Oxley a little bit, and we're very much in it's really a lobbying group of us. But the great thing about the National Venture Capital Association is that whether you're a Democrat or a Republican, you're usually for this, because this is a good thing. This creates jobs.
Yeah.
And we kept on promoting job formation, which is true from small companies.
Yeah, most of the jobs are created by smaller companies.
Yeah.
That's statistically proven.
And obviously some of the big success stories have been amazing and have really kept this country, really ahead of the game on a worldwide basis in terms of, technology and change, and it's very exciting.
Yeah.
So, being on the board of that was I would say good fun, and we met in Washington some very important people, like shook hands with Mr. Bernanke and the Federal Reserve Chairman, and we made a presentation to him. He probably was bored stiff because he was bored stiff, I should say, dealing with the financial crisis after 2008. So this was light relief to go and listen to a bunch of people telling him good news about venture capital.
So, but along those lines, so this is more recent, the Jobs Act, and especially like, I guess they call it Part 1, Part 2, or Part 2 and Part 3. You know, one about kind of startups, like traditional startups that we've been involved with. The other one about crowdfunding. I mean, what's your thoughts around, you know, the Jobs Act generally, and is this a good thing, or what do you think?
Well, I
about
think it's
that?
definitely a good thing and a trend in the right direction. And I do think, again, somewhat reluctantly to say it to an American, of all people, you know, that the government could do any good, but you know, they're trying to, and maybe some good will come out of it. I think a lot of frustration, of course, will be felt along the way. There is, you know, the danger of fraud, and there is going to be and there are some shysters who are going to take advantage of cutting corners, and there won't be full disclosure on the investment opportunities. But I think crowdfunding is a good thing, and I think that you know, this Reg A Plus is a good thing, by which you can raise a lot of money without having a public offering, and you could have a public market for it. The SEC has experimented even, I believe, and has a pilot project going with respect to widening the spreads on IPOs, or, you know, for smaller companies who have it regularly.
So to attract more investor
because
interest.
Investment bankers have to make money, right?
Sure.
And they are taking more risk, and so why not? In a sense. So I think a lot of...
Although my friends that are investment bankers, I rarely feel sorry for them with how much money they make.
That's certainly true. That's certainly true.
So what is the favorite thing and least favorite thing you like about working with entrepreneurs?
Well, the most favorite thing is that, you know, you have an impassioned entrepreneur who wants to change the world. That's the best type of entrepreneur. The second type of entrepreneur who could also be very good at making a lot of money is one who's purely in it, a mercantile kind of individual who just wants to make money. That's okay, but changing the world...
But passionate in both cases.
Yeah, passionate in both cases.
You're passionate about this.
My preference would be for the first type, because to change the world is, and also has a good business plan behind it, is probably going to generate bigger returns. I can't prove it, but sort of feel that viscerally. So I think dealing with these highly motivated, impassioned people who've got a great idea and are leaders and can put together a group of people and really stimulate them and inspire them, I mean, that's fascinating to work with people like that. So that's the most fun. I think taking company public, it's been a long time since, except your company we were able to take public, I guess. But that's pretty exciting, a company going public. Didn't you agree?
It was a challenging time, you know, during the initial meltdown of the U.S. economy. But it was exciting. It was exciting for employees. It was exciting for investors. So it was, you know, followed by the next year and a half of extreme difficulty in the overall economy. But you know, it worked out, you know, over the longer term. How about you know, how do you identify like the best investment opportunities? I mean, what's your scouting plan? You know, do you good entrepreneurs just come to you as a venture capitalist, or you know, how do you do the matchmaking, and you know, how does that work?
Well, I think the first point is I would make, any time you put a sign up saying you've got money to invest, you will get, it's like bees to a honeypot. You will get a lot of business plans. In fact, your time will be could be completely consumed by trying to read these darn things and making quick decisions as to whether you cull them down. So that, I think, is, unfortunately, in some ways, you could say, the reaction of many VCs. They're reactionary. They're not necessarily proactive and sort of say, I want to invest in this area, I'm going to go after it, I'm going to find the best, you know, entrepreneur or scientist or engineer in that area. Some people do that, perhaps on the very early stage, more seed style investing. I mean, I think it happens with biotechnology when they say, well, there's a really opportunity to build this compound, you know, that will treat this cancer, and this university has already done some work in that area. I'm going to find the best researchers. Some people do that, but in general, I would say that's not the way it happens. So you get all these business plans coming in, you cull them. It would be what would be intelligent thing to do, and we've certainly tried to do it in our partnership, which is, identify areas that appear to be likely in the next few years to be promising areas to invest in.
Okay, so kind of market segments that, okay, these are the most promising market
yes,
segments.
so be more receptive to those segments, even do some, research and work in those segments to understand, the lay of the land, what the issues are, and then be receptive to business plans that come in that area, and perhaps prioritize those and tend to put them to the top, because it's very much this business one where certain areas get overdone. I mean, I remember, take a simple example. We did invest in a company that was trying to be YouTube.
Okay.
We were 6 months too late. There were about probably 10 or 12 companies trying to be YouTube.
Sure.
Only one won.
Yeah.
Right? So, but you wouldn't, after that had happened over a space of a year, no one's going to look at that again.
Right.
Self-generated consumer content, video. You wouldn't want to search for it again, right? So
well, why do you, like that is a case study, why do you think YouTube won? Because they were the first mover, or because they had a better platform, or
first mover, probably a good team, probably better financed, got financed earlier. It was 6 months earlier than our team, and we had actually a very good team.
Yeah.
But it makes a big difference if 6 months.
Yeah. Yeah, most technologies, that's huge. It's a big advantage.
Yeah, but you don't know about it because they're private. So
sure.
You don't know. YouTube popped up. You know. Oh shit!
That's our idea.
Exactly.
So that gets into this kind of the Kleiner Perkins, or at least Kleiner Perkins gets credit for this, around, I would rather invest in, an A team with a B idea versus a B team with an A idea. Obviously you want an A team and an A idea, but how do you discern that? Because you're looking within markets, you're saying, okay, these are the most promising opportunities, but then you might get some bluebird that's like, oh, we hadn't even thought about that, but this looks really interesting. How do you look at that, especially when you're doing early stage investing?
I actually would have a different criteria, which is more akin to Don Valentine. He used to say this when he was at Sequoia, who's very distinguished and successful VC, which was coming back to the point about markets. Yeah. Find a product or service that you believe is really beginning to take off, or is well positioned to take off, and you think it's going to be a big market, and back that. And I think his view would be, if the management isn't up to it, we'll change them. Yeah. And now, we'll find them. If we've got a really hot idea. I mean, take Cisco. Yeah. One of the big problems with the founders of Cisco. Yeah. And they're very wealthy people, but we're out of that company in no time. Yeah. Well, Don was actually on our board at C-Cube, and he used to say, CEOs come and go, as one of his phrases, and the other one was, we'll have to put him in a different area code. Yeah, right. So it's really about, from your investment philosophy, it's more about identifying big market opportunity, but the general market isn't aware this is coming, but you can kind of see it. You've got some vision where you're looking over the horizon where you see, hey, this could be a really big idea, and I've got a good team around it, but I can work with. If I've got a good idea, I can build the right team around a good idea. Yeah, I think you have to. It's very difficult. Having just said what I said, I think it's very difficult to back a company if you don't have somebody, or even if you've got the good idea, or you identify the good idea, and if you don't see somebody that you really believe is exceptionally involved in that company, usually the founder. Yeah. I'm a little bit more. I kind of agree with your comment about CEOs. CEOs can come and go in a sense. Yeah. Back in Paragon, we were the backers of Synoptics Communications. Yeah. And it became a huge winner. It was, twisted and untwisted pair wiring, telephone wiring that could take Ethernet and really manage, of course, allowed you to link all your computers together, etc. And eventually you had clustered server and etc. But the nobody at that, a lot of people at that time didn't think it was going to be a particularly big market. I remember a very well-known VC, which should go unnamed, saying, we're not investing, we don't think it's going to grow.
Yeah.
We had a different view. We'd done some work on it. We really believed that this thing was going to take off.
Yeah.
And it did. Fortunately, we didn't have, the management team was good from the start. We had the founder had managed to link up with a fellow called Andy Ludwig, who was from Xerox.
Yeah.
Who turned out to be a great CEO, and that team took it all the way through a public offering.
Yeah. Yeah, it's definitely, that was one of the big attractions for me to come to Entropic was Itzhak. Itzhak Garance, who was kind of the lead founder, the founding CEO of the company, and it was my third company I'd run, so I'm like nervous about what I would call founderitis. The founder doesn't really want you there, the stage chairman of the board, and you end up with all sorts of problems, but that was never the case with Itzhak. He's just a wonderful, amazing guy to work with, and just a brilliant entrepreneur, but knows where he's good and knows where he wants to hand things off. So that was like a great partnership from my perspective in my most recent product company.
Well, I think you're asking about the fun aspects of this business. I mean, the people aspect is a lot of fun.
Yeah.
I mean, there are some great executives you come across, and some great founders, and then some not such great people on each side. So
sure.
On the plus side, it's very exciting to work with a good team that clicks and turns out to be a huge success. My partner Leo, I believe, is a great CEO of our company, Sam Piper, and again, same as your experience, Patrick, the founders were great people to work with. And it turned out very well.
Yeah.
And other times, it doesn't, and you have to make changes, and that's a tough part of our business, making those changes.
Yeah, yeah. I mean, that gets into kind of like balancing out the different constituencies. You've got your general partners, who I guess you're most loyal with that group, your limited partners, you've got the entrepreneurs themselves, you've got other people on the board, that basically you're in an alliance with them because you have aligned interest around making the company successful. How do you balance out all those different constituencies as a venture capitalist?
Well, starting with the GPs, I think different venture firms have different structures and different ways of working together. Some are dominated by a particular individual who's got a very strong personality or has got a very long and successful track record and is regarded as first among equals, or indeed number one.
Yeah.
And in the way in which we had worked, we preferred a more collaborative and I would say equal structure, where we all had a voice, even the junior partners had a voice. And the relationships with LPs are pretty straightforward, and have been in our case. We've always tried to be very open about where things stand and frank. And we've had some good LPs, very professional. We've never had a contentious issue with our limited partner investors. With management and co-investors, that sometimes, it can be tricky sometimes. It can be, there can be conflict there in terms of your interests and their interests.
Sure.
And you try to work it out as best you can.
Yeah. So what's been the most gratifying thing you've done in your career?
Well, actually, it's not a venture capital thing at all. I suppose starting from scratch in Malaysia, a little merchant bank that in a new market where they weren't used to merchant banks at all, and to bring it to profitability within 3 years was very satisfying, very challenging, worked my ass off, but different culture.
But you were basically an entrepreneur in that case. I mean, you had a new company.
Yeah,
you had some financial backing, but you're out there in the jungle.
Almost literally, Malaysia. Buying the paper clips to start with, and getting the furniture arranged. Yeah, absolutely. Yeah.
That's awesome. So, and what's been like the most difficult thing in your career?
Well, negotiating in Portuguese in Brazil with a subsidiary of Corning Glass on taking the company, doing a public offering for them.
Okay.
That was very difficult. Because I knew he could speak English perfectly, but he wouldn't.
But you speak Portuguese.
But I speak Portuguese. Well, I had to speak Portuguese. Not very well, though. Not very well. But, you know, in recent times, I think, you know, I think, you know, the sale of a successful sale of a company, obviously, or an IPO, an exit, is really gratifying.
Yeah.
And the ability to send a check back to your LPs.
Sure.
And that's an exciting moment. That's
Yeah.
good. It's happened a number of times, so
yeah.
I don't know which one is more exciting. Problems.
But it's exciting whenever that happens.
Yeah,
whenever you have a big
happens.
liquidity event, you know, and you're able to, you know, have
Right.
a victory basically.
Yeah, that's why I hugged you. We hugged you when your company went public.
Yeah. You're not a big hugger either. So tell us a little bit something about yourself that most people don't know.
Well, I don't know. I you know, nowadays the world has changed a lot, but I'm quietly proud of the fact that at a time when interracial marriage was a very unusual thing, even relatively in California, you know, I married a Afro-American gal, and we have a beautiful daughter. As a result, she's 35 years of age. But at the time this happened, this was quite unusual.
Yeah.
And so I don't think most people know that about me.
Yeah.
They're a little bit surprised.
Yeah. And another couple things that I know about Robert, because we have hung out a little bit and talked about, Robert is an expert skier.
And
so
a terrible golfer.
And so his son, and he does fox hunting, which I didn't even know people did fox hunting anymore. So.
Oh, we hunt coyote. It's a totally futile operation because we never catch them. They just laugh at the hounds.
So is there anything else that I missed that you want to talk to, you know, our entrepreneur audience about?
Well, I you know, anybody who's in the entrepreneurial community, I praise you, I admire you, you're our customer. You represent the engine of growth for this country, the future in terms of developing, I think, to a large degree, the underpinnings of an important part of our economy. So I bless you. God bless you, and keep at it.
All right, awesome. Well, thank you, Robert. Really appreciate you doing this with us today. This is Patrick Henry from QuestFusion with the Real Deal What Matters.